Somewhere between 2020 and early 2022, a letter started being drafted for you. You don't have it yet, and maybe it's not coming for another couple of months. But if you bought a home in Toronto or anywhere in Canada during that time window, it's coming. It's your mortgage renewal notice. And when it arrives, it's going to have a number on it that's going to feel like a gut punch. $900 billion. That's how much Canadian mortgage debt is up for renewal between 2025 and 2026. That's not a typo. Nearly 2/3 of all mortgages in the country are coming up for renewal in that time period, and the vast majority of them originally locked in at rates well under 2%, which we're never going to see again. They're renewing into rates that are double what they were paying previously. I've been a real estate agent in Toronto for over 9 years, and the number one conversation I'm having with people right now is not with buyers, not with sellers, but with people who already own their home, who are terrified of what's going to happen when that letter finally shows up. Today, I'm going to walk you through what's actually happening, what your real options are, and what I'm telling my own clients right now. Let's get into it. This video is for 3 groups of people. If you bought a home between 2019 and 2022, and you're on a 5-year fixed mortgage with a renewal sometime between now and 2027, this is definitely for you. Or if you're on a variable rate mortgage and you've already lived through some of the price adjustment shock, you know what's already coming for these people, so it's for you as well. And the third group of people are those who know friends, siblings, family members who bought in that time window and are wondering what's going on, what's going to happen. Send them this video. It'll help them figure things out. Whatever your situation, here's what you need to know about how we got here. I'm sure I don't have to tell you this, but in March of 2020, COVID hits, and the Bank of Canada lowers the overnight rate down to 0.25%, almost free money. There are a lot of reasons for this: CERB, people not being able to work or go out. This isn't a COVID video though, but that did contribute to how we got here. 5-year mortgage rates also fell to levels that we'd never seen before. We're looking at mortgage rates in the 1.5% range for a 5-year closed, and there are variable rates that were under 1% being offered. Families in the GTA locked in these mortgages while home prices were surging, especially outside of the GTA when people were moving out of the city. 70% of people who are renewing between 2025 and 2026 got their mortgage during this exact time window. So inflation hit 40-year highs in 2022 to 2023. As well, the Bank of Canada increased the lending rate from 0.25% all the way to 5% in under 18 months. This caused people on variable lending products to have a huge rate shock at that time, while everyone else who was locked into mortgages, myself included, was kind of watching, looking at that future date in the distance as it slowly got closer every day. And that brings us to today. Right now, the renewal wave is happening, and like I was saying, 2/3 of all Canadians are renewing their mortgage within the next year, and most of them are going to experience a huge rate shock. Almost 70% are going to have a rate that's going to be almost double what they originally got, sometimes more than double that. It's a car payment coming out of nowhere. So that's how we got here. Now let's talk about what it actually means for your wallet. So let's say you bought a condo for $800,000 in 2021 with 20% down. That's a mortgage of $640,000. Let's say your mortgage rate was 1.99%. Your monthly payments would be about $2,700, a little bit over that. Now today, if you're renewing at a fixed, let's say 5-year closed, at around 4%, your mortgage payments are going up by over $670 a month to over $3,300. That's a 25% increase, and that equates to over $8,000 more per year. Or let's say, for example, you bought a semi-detached for $1 million with $800,000 down. Well, your original mortgage payment would be about $3,400 a month, just a little bit under that mark. Your new mortgage payment would be over $4,200 a month. That's a monthly difference of almost $840 and over $10,000 more per year. You can see how this can be so shocking to people and why we really need to prepare and budget properly for this and not just treat it like something that's going to happen far off in the future. That was fine a couple years ago, but today, those mortgage renewals are coming due. They're coming due in September, October. They're coming due sometime this year, most likely for most of us. So it's time to budget. It's time to start looking at real numbers and look at places where maybe you can save a little bit so that you're not taking on a bunch of other things in addition to a big mortgage payment increase. There was a Bank of Canada financial stability report that came out in May of 2025, which said that for people who bought during the pandemic, there would be a mortgage increase of about 20%. And that's right in lines with the numbers we're estimating. We're estimating here about 25% increased with the numbers we were just looking at. The other thing to consider too is if you locked in at rates even lower than this 1.99% we're showing as an example, if you're closer to 1.4, 1.5%, and you jump all the way up to 4%, you're going to actually be paying even more than we were looking at here. Now, there are mortgage rates today you can get between 3.5% to 4% for 3-year, 5-year closed, but that does vary a lot depending on your credit score and which bank that you're with. I'm going to touch a bit more on that as we go throughout the video. But the payment shock is only half the story, believe it or not. For Toronto homeowners, there's a second problem, and it could be even worse. So I'm going to call this next part the equity trap. And if you were around during 2008, the financial crisis, and you watch movies like The Big Short, you might remember the term shadow mortgage. Well, unfortunately, there are a lot of Toronto owners who might find themselves looking up what that means. So let me explain it to you. Essentially, a shadow mortgage is when you owe more on your property than what it's actually worth at the moment. So let's say you have a mortgage for 1.5 million, but your house, because of the market drop, is only worth like 1.3 million, 1.2. You owe more money than you actually own, which is a pretty rough spot to be in. Now, let me explain how this could happen with numbers, very real numbers from Toronto and the GTA. So let's say you bought a house for just over $2 million at the peak in 2022. You put $440,000 down, your life savings, so that would be 20%. From that time period of 2022 to today, detached home prices are down more than 20%. So you could end up with a situation where you have a property that is worth close to 1.6, but you owe more than 1.6 on it. It's a very real situation that homeowners are facing right now. Additionally, especially for condo investors who bought pre-construction projects in 2020 to 2022, especially around 2022 again, because that was the peak, a lot of those projects that are finishing today or have finished in the last couple of years are worth less money than what people originally bought them for. From that same Bank of Canada report in May of 2025, they found a bunch of situations where people bought condos for $1 million and those same condos are worth close to $700,000 now. The reason it's so tough on investors specifically for pre-construction, and my last episode touched on this, is pre-construction projects already price in a future market increase to their units, or at least they used to when the market was going up and up. So not only were prices so high in 2022, but pre-construction developers were also including a 3 or 5 year price increase for when that project was actually going to finish. So you end up with these really unfortunate and tough situations for a lot of condo investors who bought pre-construction during that time period. So it's kind of like a double squeeze. You know, you're squeezed on one end with your mortgage rates increasing, and especially if you're on a fixed rate, increasing by quite a bit. And at the same time, your property has likely decreased quite a lot. So if you find yourself in that situation of buying during 2020 to 2022 and locking in a rate at that time, it can be a tricky situation to navigate right now. So that was a lot of doom and gloom, but what do you actually do right now? Well, the way I see it, there's three main options, and I'm going to walk you through each one. So the first option, which is pretty obvious, is you can just renew with your current lender. So that's obviously the path of least resistance. You're probably already pre-qualified and they'll just renew you. One thing to consider is a lot of times the first renewal offer that your bank gives you is not necessarily the best rate that you could get. So I would encourage you to shop around a bit, different banks, even mortgage brokers who have access to credit unions and other places. Try and compile the best rates that you can. And even if you want to stay with your current lender, at least bring them back a bunch of different rates, or maybe even just the lowest rate you found, and try and get them to compete with that. Even something like a 0.25% decrease on your mortgage rate can save you thousands of dollars, tens of thousands of dollars over the life of your mortgage. The second option is you can refinance your mortgage. So this is either ending it at your current lender or maybe finding a new lender to go to. And this can give you a bit more flexibility by letting you access some of your equity or even extending your amortization period if you want to try and lower your monthly mortgage payments. Now, something to keep in mind is the longer your amortization is, the more interest you're going to pay. Another quick tip I know from when I was a financial advisor for 6 years is if you do weekly or bi-weekly mortgage payments, you're going to actually do a couple more payments per year, and those payments are going to go more towards the principal of your mortgage, sometimes entirely on the principal. So that's a bit of a quick interest savings tip if you can take advantage of it. I know flexibility in budgets is not really high right now, but if you're able to, versus monthly payments, you actually do pay off your mortgage quite a bit sooner. And I'll have a Rate Hub mortgage payment calculator, which I find is the best one, in the video description. But you can see actually that small changes you make, like little prepayments here and there, or changing to bi-weekly or weekly from monthly payments, does actually help you pay off your mortgage quite a bit faster. There's also a new federal rule that all new buyers can amortize their mortgages up to 30 years. And all buyers of new construction properties can also amortize up to 30 years. So that helps reduce your monthly payment costs as well. Additionally, the insured mortgage cap has raised from $1 million to $1.5 million. What that means is previously, if you know what CMHC is, you had to put 20% down on any property that was at least $1 million. Well, within the last year or so, the government increased that to $1.5 million. So now only above $1.5 million do you have to put that full 20% down. You should also watch out for legal costs that can pop up during your refinancing, as well as being stress tested at the new rate, which can be above 5%. And if your income or credit has changed considerably since when you first locked in your mortgage, there is always the possibility that you won't qualify for the mortgage again if you do refinance. So I would say make sure you talk to your mortgage advisor or to a mortgage broker before you take any big steps, just to make sure you know all the costs involved and all the legal ramifications. A third option you have is to sell your home. So when the market is down like it is now, Upsizing is actually a good strategy because you pay less on the more expensive property. Yes, you're going to get less for your home as well, but if we look at it percentage wise, it does make sense financially to pay less on the property that's more expensive. This also makes a lot of sense if, let's be real, if you bought a place and you thought that you could carry it, but now with this increased mortgage payment, maybe you realistically can't. And that's fine. A lot of times you can sell your home, you can get a smaller mortgage, maybe go to an area that's slightly less desirable, but get a bigger house, cut down your mortgage a little bit. You can trade sideways on price, but maybe move to a bigger property. There's a lot of situations where it could make sense. And of course, if you bought outside of this time window, if you're sitting on a lot of equity, the price decreases might not matter as much to you because you might have a lot of equity built in your home. So in that situation, you're a bit insulated from the price decreases and the rate increases. Most 2020 and 2021 buyers do still have real equity that they can take advantage of through selling or through refinancing. If you bought right during the peak of 2022, you might not be in that position. But if you can hold on, markets are cyclical. Just like the market wasn't going to go up forever, like people thought it would leading up to 2022, the market's not going to go down forever. I have a good friend who told me his parents said they always ended up just buying and selling during the worst time that they could. Not on purpose, of course, but just life happens. And over 40 years or whatever, they're still in great shape. So it might seem doom and gloom right now, but if you're able to hold on, Toronto markets, especially closer to the city, do have a good history of rebounding pretty well. There's also a layer to this most people never hear because your bank's never going to bring it up. So the first thing to know is that you can lock in early if you want to. Most lenders let you lock in a mortgage renewal rate within 6 months of your renewal date, or 4 and 5 months in some cases. So that is an option if you're worried about rates going up between now and then. Now, nothing I'm saying here is legal advice, but I don't really think rates are going to be going up anytime soon. The Bank of Canada has almost come out and said that rates are going to be held all the way until 2027 at this point. But if you do want to get ahead of it, you can ask your bank, what's the best rate you can give me right now if I do renew and lock back in? And again, I would encourage you to do your research first, find the best rate that you can get. And if you're wondering about that, you can reach out to me too. I know some quite good mortgage advisors I can refer you to. But do your research and say, yeah, what's the best rate you can give me if I'm going to lock in right now? Now, when you're renewing, variable isn't dead. Most of the banks are going to send you a renewal notice that has fixed rates as the lead, but you don't have to go fixed. Sometimes you can actually get variable rates that are lower than fixed right now, and that might not be such a bad option. And just like I was saying before, a broker can see a lot of things that the bank doesn't. So your bank just has access to that bank's lending rates. Whereas if you go with a mortgage broker, or at least meet with one to see what they can offer, they have credit unions available to them. They have all the banks generally. So I would advise at least shopping around at a broker and just seeing what's out there and what strategies they might be able to use. Even if you don't want to ultimately go with that broker, at least see what they can offer you and what you can use to leverage against your own bank's lending rates. If you do hear people telling you it's 2008 all over again, the market's going to collapse, let's just backpedal there for a second. This isn't 2008. In almost all cases, CMHC estimates over 90% of cases, banks stress tested people at higher rates than they're going to be renewing into now. So if you bought a home, you should still be able to afford it according to what those stress tests were at. I know it might not realistically feel like that sometimes, But the bank did do their best to make sure that there wouldn't be a huge default crisis like there was in 2008 in the States. As well, the household debt to income ratio has increased from around 180% to 173% over the last year. So this is stress, not total collapse, but stress still demands action. Let me bring this back to real life. This is what conversations look like with my clients today. There's probably three main categories that I'm seeing the most. One is dual income couples that might have bought during this time window, but their incomes might have also increased during this time. And let's say even if they have, a semi-detached where the mortgage is going up $800 a month, it's pretty rough. It cuts into their savings, but ultimately it's not going to affect them too much on a day-to-day basis. So if you're in this situation and you want to stay put where you are, I would suggest that you renew your mortgage, try and adjust your spending accordingly so you can build in that new buffer, readjust to your increased costs, but you should end up being fine. Or you could be like one of my clients who bought a condo, and now with the increased monthly payment costs and also with the prices dropping, and also even the rents dropping a little bit, they're just going to have to sell. So that's just the reality. They put 10% down. They were hoping that the market was going to keep increasing. It obviously hasn't. No one can predict these things. And if you're in that situation, what I would say is just do your best, market the property as best you can. Especially in a down market like this, it's really important to have good strategies when you're selling. You really need to price the property properly. It's a tongue twister, but you really need to. If you're priced too high in a market with so much supply, you're just shooting yourself in the foot right away. You're not going to get showings. You're not going to get the offers that you want. I also have another couple in the suburbs who bought in 2021, and one of them ended up having to go part-time. So they're going to have to sell, but they do have a little bit of equity built up, and they can kind of shift into a similar size property in maybe not quite as desirable an area, but keep a similar mortgage. And I just want you to know, if you're in that situation, you haven't failed. If you need to just adjust your lifestyle and your home according to the new financial picture, that's a reality a ton of other Canadians are dealing with. You're not alone. And we're kind of taught growing up, or at least I was, that housing is this super safe investment you could just always count on forever, and it's never going to drop like we've seen between 2022 and 2026 today. But of course, we've all lived through that now, some of us multiple times. And it's important to know you're not failing. You didn't fail. You're just reacting to the realities of the market. And sometimes the market just really forces your hand, and you just have to make the best strategic decisions in that situation, the best decisions for you and your family going forward. So what do you actually do next? Well, here's your action plan based on exactly where you are in the timeline. If your renewal is more than 6 months away, you obviously have some time. I would still suggest looking at what your monthly payments are at a 3.5% rate, a 4% rate. Maybe call up your bank and try and get the exact renewal options right now and do a budget based on those numbers. I would also say start informal conversations with your broker. If you're 2 to 6 months away, it's time to take action now. You should be getting quotes from 2 or 3 lenders, from mortgage brokers. You should be figuring out if you're going to be staying, refinancing, renewing, if you're going to sell. Because the reality is, if you are going to sell your home, you probably want to beat the spring market that's going to be coming up soon. So you're going to start needing to do repairs, figuring out staging, figuring out how to present it properly. All these things take time. It can take a month, sometimes longer, to get your home ready to be presented to the market properly, especially in a down market like this. If your renewal letter has arrived, don't panic. You still have some time, but it's time to get some serious quotes. Don't just accept the bank's first offer. Make sure you go back and forth, speak to a broker, see the best rate that you can get for yourself. I'd also suggest, if you're thinking of selling, or even if you need it for the banks, getting a market evaluation on your property, just so you know your options, how much your home is actually worth in today's market. I've been doing some market evaluations recently for people who bought, let's say, between 2020 and 2022, and you should know that those numbers have shifted significantly. You can't just count on whatever valuation you got 3 or 4 years ago. Those numbers have changed quite a bit. If your renewal is imminent, just keep in mind you have weeks to make this decision, not months. So you really do have to get your foot on the gas pedal and start moving. And if you've already renewed and your payment is higher, you're not alone. Millions of Canadians are here. But just a question for yourself, are you absorbing the new payments? Are they affecting your lifestyle much? Are you burning through savings? Are you piling up credit card debt? You know, it's good to be honest about these things and see if you need to make a change. If you're managing, stay the course, build up that savings buffer. But if you're not, it's time to have those difficult conversations now before things get out of hand. Here's what I want to leave you with. The mortgage renewal crisis is real. $900 billion of Canadian mortgages renewing into totally different and increased rate environments. Payments going up 20 to 25%, and at the same time, price drops between 15, 20, 25% on those same properties over that time period. Those numbers are what they are. Nobody's gonna bail you out of mortgage payment shock, and the rates are not going back to what they were in 2020 anytime soon. But this is not a catastrophe if you deal with it properly and you see it coming in advance. The people who are going to get hurt by this are the people who wait, who assume it'll work itself out, or who sign the first lender renewal rate without comparing rates or asking any other questions. If you watch this entire video, you're not that person. You're the type of person who's proactive, who wants to know your options, and who processes the information well in advance. If this was useful, and I genuinely hope it was, here's what I'd ask. If you could share this video with one other person that you know who is in this situation, and just trust that it will give them a bit of peace of mind and help them out, even if you're not going through this personally. We've seen there are millions of Canadians who are, and if you're like me, I like getting as much information as I can when I'm facing these big financial decisions. And this video, I think, can help give some peace of mind to those people. If you want to talk through your specific situation, I've been a realtor in Toronto for over 9 years. You can reach me at 416-908-6124. I'd be happy to go through your situation, let you know my expert opinion on it. It's a tricky market to navigate at the moment, and the reality is making the wrong decision can cost you tens of thousands of dollars, if not more, at the moment. Thanks so much, as always, for watching. If you like the video, please like and subscribe, and I'll see you next time.